Every failure is an opportunity to learn. It's a beautiful, timeless phrase. But they don't tell you the uncomfortable truth. Every failure costs you something. And in the world of investments, that cost is usually a significant chunk of your hard earned money. Look at the last 67 days of this US Iran war. When it broke out, what did everyone yell? Buy the dip. It was the ultimate retail consensus. You watched people blindly throw cash at crashing domestic stock charts, expecting a quick recovery. But as the shipping blockade dragged on, the market kept bleeding and the narrative changed. Suddenly, the gurus stopped shouting buy the dip and started saying you need to diversify. And just like that, the Sunday newspapers were flooded with full page ads from mutual funds. Stay calm, stay disciplined, start and diversified SIP. Now let's be fair, they are not actually wrong. SIPs work. Accumulating assets over 10 to 15 years is a bedrock of building wealth. But notice how none of those ads spell out how to actually handle a micro crisis. They give you a comforting buzzword, diversify, but they leave out the blueprint. They make you think that buying different local funds means you are safe. If making money was as easy as buying a dip and starting a generic SIP, we would all be rich by now. The last 67 days proved the standard playbook has a blind spot, and it's a great opportunity for all of us to actually learn something here instead of going back to the same old investment tricks. So think about it. Crude oil spikes past $110, the rupee bleeds past 96, and your private bank, your favorite automaker, your paint company, and your FMCG stock all crash together. And you thought you were diversified all this time because you have 4 different sectors. In reality, you had one single macro trade under 4 different tickers. They all share the same vulnerability to input costs and capital flight. What you think as diversified is just a collection of different versions of the same trap. And today, we are treating these 67 days as a reality check. No cynicism, no data. We are going to look at why old methods fail and how to turn these macro shocks as your biggest advantages. So let's look at the facts now. The first lesson is very simple. We need to change how we look at companies' expenses. A geopolitical shock acts like an invisible tax on corporate operating margins. If a company cannot pass that tax on to the consumer, its earnings will collapse. So what does real diversification look like here? Stop buying companies just because the price fell. That is a trap. Instead, you must balance your energy consumers with energy producers. If your portfolio is exposed to high oil via paints or autos, you balance it by holding upstream oil exploration, domestic coal, or green energy utilities. When energy costs squeeze your consumer stocks, your energy producers experience immediate revenue expansion. It's a natural shock absorber. Simultaneously, look at sectors where the primary cost is intellect, not physical commodities. Sectors like IT, pharma, and digital SaaS don't get their margins destroyed by a shipping blockade in the Persian Gulf. Now, let's talk lesson number 2, which is about modern risk management. The old school advice was always, if stocks bleed, hide in gold. But look at the last 67 days. Gold did not save anyone. It cratered from its highs down into the 4,500 range. When yields climb because central banks are fighting inflation, holding a non-yielding metal gets expensive. Even safe havens get liquidated when cash becomes king. The commodity hedge is outdated. Risk management today is about building a geographically diversified, borderless equity portfolio. Let's look at who actually won over the last 2 months. While domestic growth engines like the Nifty Next 50 took a massive hit, sliding down towards 69,000, the S&P 500 marched straight to all-time highs, shattering 7,470. If you stayed 100% concentrated in the domestic market, you watched your wealth stagnate. But if you allocated a portion of your capital worldwide into an S&P 500 ETF, your portfolio would have thrived. First, the global index captured international momentum and safe havens flow. Second, because your rupee slid past 96 to 97, your US dollar exposure gave you a massive currency tailwind that completely offsets your local losses. So this is the actual diversification. It's not about changing sector names on an Excel sheet in Mumbai. It's about diversifying your geographic and currency risk. Global capital is fluid. When a crisis hits a major oil importer like India, capital cycles into global safe havens. By owning both sides of the corridor, you catch the upside that the capital cascade wherever it lands. A global portfolio turns international currency risk into your primary defensive asset. And I have covered this in one of my earlier videos as well. The third and final lesson is about consumer psychology. When energy costs spike and uncertainty rises, households enter survival hoarding mode. They delay upgrading phones, they put off buying cars, and they cut back on lifestyle retail. But they cannot stop using electricity. They cannot stop buying medicine. And they cannot stop buying groceries. So during a macro crisis, the growth phantoms, companies riding on the hype and consumer credit will evaporate. The state stops prioritizing consumer apps to aggressively redirect capital into sovereign infrastructure to build physical blockade-proof supply chains, like the Middle East, India deep water pipeline. And I have covered that in another video as well. So what should be your move? Move up the ladder of economic gravity. Reduce exposure to cyclical consumer stocks and anchor your money into inelastic utilities and sovereign CapEx. Invest in the sectors the nation requires to function, independent of retail sentiment. Look at power transmission, city gas distribution, the public sector engineering conglomerates like Engineering India Limited. They operate on long-term government-backed contracts which are insulated from retail spending. The last 67 days have been a painful but a necessary wake-up call. It proved that blindly buying the dip and trusting generic index diversification in one country is dangerous. Those newspaper ads telling you to stay disciplined with your SIP are right about the destination. Compounding works, but you have to be smart enough to build the right vehicle. So true diversification is not about having a long list of tickers. It's about ensuring your assets don't share the same exact vulnerability to a single macro shock. So stop gambling on catchphrases. Understand global capital flows, diversify geographically to capture currency tailwinds, and align your investments with sovereign reality rather than discretionary phantoms. This is the logic behind survival. And if you want any more information, you can always just message back or tune into me. Here on this channel, we look at all economic updates through the lens and only one lens of mathematics. Okay? So if you would like to join the community of our smart investors, maybe you should think about subscribing. And if you like this video, please hit that like. So thank you for tuning in and thank you for your time. Have a great day. Bye-bye.